Welcome to this edition of Investment Insights. Today we have Paddy Brown with us. Hi Paddy.
Hi Tatiana.
Paddy, how did the investment markets perform during the second quarter of 2024?
Equities were largely positive across the second quarter, with emerging markets outperforming developed and growth outperforming value. The group of stocks labelled as the Magnificent Seven, which account for around 30% of the MSCI World Index, all delivered positive returns for the period, albeit at varying degrees. The bond market delivered mild returns across the board, with credit outperforming government bonds. The New Zealand dollar strengthened against most major currencies. This strength ultimately provided headwinds for unhedged assets. The Japanese yen was a notable call-out, as the yen lost around 8% versus the New Zealand dollar. This move is good news for anyone travelling to Japan or importing goods from Japan, as the purchasing power of the New Zealand dollar has increased.
On 30th of May 2024, Finance Minister Nicola Willis announced the 2024 budget. What impact do you think this will have on the economy?
In the 4 years since the initial outbreak of COVID-19, government spending has exceeded income, resulting in multi-year budget deficits. Support measures throughout the pandemic were a key factor in this. The coalition government's budget has come with a focus on reprioritising government expenditure and returning the operating balance back to surplus by 2028. The 2024 budget combined a well-signalled tax relief package alongside significant savings in the public sector. Whether the tax relief will have a material impact on inflation, forcing the Reserve Bank of New Zealand to maintain the current cash rate at the current level, depends on how much of the tax cuts households will actually spend.
As we enter quarter three, what are some of the key trends we're likely to see in the investment markets?
We expect to see investors focus more on fundamentals. For example, refocusing on earnings growth, company profitability, and those companies which are higher quality in nature and are able to better withstand higher cost pressures while generating returns. We may also see the more cyclical areas of the market start to pick up, as central banks have seemed to steer economies away from a hard landing recession into what is now widely referred to as a no landing recession. In general, we expect a more broad-based market performance than we have seen in recent quarters. Certain areas of the market are still looking expensive from a price to fair value standpoint. In particular, the US large cap growth sector, which has been driven upwards by the aggressive focus on AI technologies, which we have seen over the last 12 to 18 months. However, the strong share price performance has largely been met with earnings growth, particularly for the Magnificent Seven. While this year has seen more divergent performance from that sector, and commentators are now referring to a Fantastic Four, there's nothing to suggest that the strong winners of this field can't continue to grow. Also, as we head into the final months of 2024, we can expect to get more clarity around the movements of key developed nations' central banks. During the second quarter, we began to see divergence amongst major central banks. Some of them, including the European, Canadian, Swedish, and Swiss central banks, have already started cutting interest rates. At the beginning of this year, investors anticipated that the US Federal Reserve would deliver 7 cuts. This has since been revised to only 1 interest rate cut this year on the back of persistently strong US economic data. The European Central Bank cut their rate by 25 basis points in June, in line with expectations. This was despite their inflation rate sitting at the higher end of their target range. This could signal that they are comfortable with having inflation sit at the higher bounds of their target. The Reserve Bank of New Zealand has remained consistent in their messaging that the first cut will come in 2025. The New Zealand economy exiting the short-lived technical recession in quarter one will give the Reserve Bank of New Zealand confidence in holding higher rates for longer.
Thank you, Paddy. And thank you for watching this edition of Investment Insights.